Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from Gene. Alan, on September 24th, 2018, I bought 11,000 shares of AMRN, AMRN, at $1.88 and sold 60 contracts for the 2019 $5 calls for $1.17 and 50 contracts of the January 2019 $7 calls for 60 cents. Today, October 5th, the price is up to $20.29. I'm sick to my stomach when I think of all the profit I'll have to leave on the table when these options are exercised. Can you give me choices to recover some, if not all, of this potential profit being left on the table? Thanks a lot, and it's signed Gene. All right, well, first of all, what we want to do is we want to have a look at Gene's trades and see if he does in fact have the right to feel sick to his stomach. All right, to do so, let's start by reviewing Gene's trades. On September 24th, 11,000 shares of AMRN were purchased at $1.88, and that same day 60 contracts of the January 2019 $5 calls were sold for $1.17, while 60 contracts of the January 2019 $7 calls were sold for 60 cents. The day that I received this email, October 5th, AMRN was trading at $20.29 and had a huge gap up in price over a period of 11 days. Here's what we're going to evaluate in this video. How should the trade status be viewed? Does Gene have the right to be sick to his stomach? What are the action choices? Remember, after we enter a trade, under all situations, we must be prepared for exit strategy opportunities. Are these actually opportunities that Gene or anybody else in this position should take advantage of? And the third thing we're going to evaluate is, are there any lessons learned from these trades? And just to give you a hint, I wouldn't be creating this video if I didn't feel that there were some very valuable lessons to be learned from Gene's trades. So I'm very grateful that Gene did share these trades with me. Okay, so that said, let's have a look at the initial calculations, the initial time value returns, using the multiple tab of the Ellman Calculator to see how things started when this trade was first initiated. And the blue cells on the left show the actual trade that we just reviewed, the price of the stock, the two option strike prices. The expiration date was the same for both of these strike prices, that is January 18th, 2019. And if we look over to the three columns on the right, we could see that the $5 strike in the top row had a ROE, or return on option, initial time value return on option, of a whopping 62.2%. Now remember, these are 4-month trades, so that annualizes out. You multiply that actually by 3. Not only that, but have a look at that upside potential. If the price of the stock went from 188 up to the 5 strike, that would add on an additional 166%. So the potential 4-month return when the trade was initiated was 228.2%. To annualize that, you would multiply it by 3. That's nearly a 700% annualized return. Now the $7 strike was even greater. We had a 31.9% initial time value return, which of course is lower than the ROE for the 5 strike. However, the upside potential from 188 to 7 is much, much greater, 272.3%. So we have a potential return for 4 months on the 7 strike of 304 2.2%. Again, to annualize that, you would multiply it by 3, bringing us over 900%. So let's stop for a second and have a look and see, is this really a good underlying security for the conservative strategy of covered call writing, or for put selling, if that's our favorite strategy? The answer is no. And the reason is, you're not going to get these kind of humongous returns unless the underlying security had a huge implied volatility. That means there's a lot of risk in these type of securities that generate huge returns like these. Now, that said, if you wanted to take a chance on a stock like this, have a separate portfolio, set aside cash that you don't actually need, you know, the kind of cash that you might spend in a casino, and set that aside for riskier stocks like these. But if you're a conservative investor, what you're doing is you're taking a conservative strategy like covered call writing and turning it into a much riskier strategy. Now, obviously, so far, this trade turned out fantastic. However, the price of the stock could have gapped down just as easily as it gapped up. So that's the first thing that would hit me when I was looking at this trade. Now, let's take that information of the initial trade and let's have a look at a 1-month price chart of AMRN, and just to visualize what happened with the price of this stock. And you could see here from the arrow on the bottom, at the time the trade was initiated, that the stock was actually consolidating, going sideways, and then all of a sudden in a couple days, boom, it went to the moon. And you could see on that top arrow went all the way up to 2029. So something happened after those trades were initiated that caused that huge gap up in price. So what I did was I turned to one of my favorite resources for stock news, and that was finviz.com, and I took a look what caused that price acceleration. Well, the main thing was one of the company's products, Vasipa, which is used to reduce triglyceride levels in our blood, had a very favorable report. And so that's really was the main motivation behind that price gap up. Investors saw that as a reason for the price to go much, much higher. In addition to that, at the time, there were a lot of rumors about the company being acquired. So that also, that news, those reports caused the gap up in price from $2 up to $20 in a very short time frame. Okay, so that's behind us now. So what are our position management choices, if any, regarding this particular situation? Remember, we're 11 days into a 4-month contract expiration. Lots and lots of time left. So what are our choices? Well, one choice would be to take no action at all. We have these humongous annualized returns, and we have 3+ months to go until contract expiration. We could just take no action and reevaluate our positions as we get closer to expiration Friday. And remember, in addition to these huge returns we have a lot of downside protection, because we will not start eating into those returns until the price of the stock dips below the strike prices, either $7 or $5. So there's lots and lots of protection at this point in time to the downside. But one of the things we consider when a strike price moves deep, deep in the money, which means the price of the stock accelerates much higher, is we look to see whether or not it makes sense to institute our mid-contract unwind exit strategy. And that's something that I've written about in both versions of the complete encyclopedia for covered call writing. And the way this works is, when it's appropriate, we close both legs of the trade. We close our short call and sell the stock. And then we take the profits or the cash from selling the stock to buy a new stock and initiate another income stream in a completely new position with a completely different underlying. So that's what the mid-contract unwind exit strategy is, and it's based on the fact that as the strike price moves deeper and deeper in the money, the time value component of that option premium approaches zero. So the time value cost to close keeps getting lower and lower and lower as the strike moves deeper and deeper in the money. However, the calculations must make sense. After all, We're in this to make money, and we're in this to make the most money possible. So in order to do that, we have to use the Unwind Now tab of the elite version of the Ellman Calculator to do these computations for us. So that's basically what we're going to do to decide whether or not it makes sense to initiate this exit strategy at this point in time on October 5th, with 3+ months remaining until contract expiration. So what do we do? Well, let's check out the option chain for AMRN on October 5th, and we can see to close the $5 strike would cost us $15.40. Now, most of that is intrinsic value, the amount that the $5 strike is in the money or lower than current market value. So that's money we're not going to lose. We're going to spend it to buy back the option, and that cash has to be available to us. However, the price of the stock will then move up from 5 to current market value, 2029. What we want to look at is how much time value are we going to spend when we close that position. And that's what the calculator will tell us. Now the option chain for the 7 strike is 1387. Okay, so let's take that information and feed it into the Unwind Now tab of the elite version of the Ellman Calculator, which by the way is free to all premium members and available for purchase in the blue collar store for everybody else. And we're going to see the results first for the $5 strike. We buy to close, and it tells us that our return is 222.3% for 11 days. Yikes, that's over 7,000% annualized. Now the actual time value cost to close, remember I told you, the intrinsic value of the component does not cost us anything because the price of the stock is going to go up by removing that initial contract obligation. So the actual time value cost to close here is 2.2%. So we'll have a huge return and a pretty low cost to close if we decide that we want to institute this exit strategy. Now let's have a look at the $7 call. If we close that one, we see that huge return of 273%, over 9,000% annualized, and to close the time value cost to close is 8.29%. Okay, so it's much higher time value cost to close than the 5 strike. So that information is before us. Now, how do we make our decision? Well, that's pretty easy. What we're going to do is we say to ourselves the following. The cost to close on the 5 strike is 2.2% with about 3.5 months remaining to contract expiration. Can we make at least 1% more than 2.2% if we close our position and move into an entirely new position? And the answer is that should be pretty easy. So closing the 5 strike would make sense. Now the 7 strike is going to cost us 8.29%. Can we make more money than that in the 3.5 months remaining to contract obligation? Well, that's going to be much more difficult. So I wouldn't say yes for sure on that one. So if I'm unwinding, most likely I would unwind the 5 call, but not unwind the $7 call. Finally, let's have a look at any lessons learned. Well, for me, the main lesson learned with Gene's trades was the fact that AMRN is not a great stock to use as an underlying if we're using conservative option selling strategies where capital preservation is very important to us. It's really more for those with a much higher risk tolerance. Now, if our intended goals are reached, which Gene reached easily in 11 days, we have a successful trade. That's really the main thing I want to get across to you. If his goal or our goal is to generate X amount for initial time value with the possibility of an additional Y amount if share appreciation moves from current market value, 188 in this case, up to the strike price, $5 or $7 in these cases, we have a successful trade. It doesn't matter if it goes to 501 or if it goes to $20. Doesn't matter. We've reached our goal. So from a philosophical standpoint, try to make it so that these trades the glass is half full, not the glass is half empty. And to me, it makes no sense to say, you know what, I could have made more money if I used a different strategy. Now, using this strategy, you've met your goals, you've had humongous returns. You should not be sick to your stomach, Gene, or anybody else that feels that way, and you know who you are. So, exit strategies should be implemented based on what your system criteria are, things like time to expiration, the calculations which we just gave you from the elite version of the Ellman Calculator, and cost benefit analysis. 2.2% is your cost. We could benefit way more than that if we closed and entered a new position. So there you have it. What a valuable suggestion that Gene sent us when he asked us to evaluate his trades, because there's so much information that we can glean from these trades and use from now on, moving forward, years and decades, to utilize this information to maximize our overall portfolio returns. So Gene, I want to thank you so much for sharing your trades with me and with the BCI community. And of course, I want to thank everybody out there for taking the time to watch this video. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.